the 360 on Energy and Carbon podcast, hosted by 360 Energy. In today's episode, we will be addressing the serious topic of climate change. Some key points discussed today include how your climate change plans impact funds and bank loans, what your organizational board structure should prepare for, and more. These topics are meant to assist and get you thinking about your corporation's climate change plan. Now on to the episode. Welcome back, Dave and John. Today we will be getting into a pressing issue the world is affected by, climate change, but with a more financial perspective compared to last. Some of these questions are inspired by a climate change briefing for directors developed by the CPA. Let's get right into the episode. What questions are banks, hedge funds, and other investors starting to ask organizations regarding their plans and successes reducing carbon emissions?
Well, I'm going to start with investors, and I'm going to start with pension funds, because if you look at the hierarchy structure, I think that they're the ones with a lot of cash and money that are exposed to this whole thing. So there are certainly organizations and pension funds that are actually starting to get on this. Now, there's a lot more work that needs to be done, and that's a function of them being engaged and understand, but also engaging the organizations that they invest in. So it's taking, I think it takes a long time, unfortunately, but I know, because we researched this, like even today in Bloomberg Intelligence, they're saying the 10 largest US public funds, they invested in the biggest polluters. So it's saying there's $40 billion that have been invested, and 9% of the funds are combined in equity holdings in 20 highest carbon companies. So that's reality. Just I know everyone goes, well, get out of them fast, get out. That's not reality, meaning, yes, they will get out, but if they did it too quickly, their market price that they invested would drop, and so that wouldn't serve anyone. The other thing is, and I want to stress, that with these investors being involved, they can start directing these high carbon type organizations to start changing. And that's starting to happen. I think there was an announcement last week with Toyota that is now being forced by 4 hedge funds that have invested in them to start taking carbon more seriously. Now, it's interesting enough, the 4 firms that are investment firms are out of use. So I find the Europeans, as we joke a lot, how are way ahead in this game, but it's happening. Unfortunately, I wish it would happen quicker, but there's some education. So there's more of a force. There's TCFD is really engaging. It's educating those investors on what to do and how to push that to the customer base. So that's happening, and it's starting with a few, and it's moving fairly quickly, or it's moving quick. The next tier that you want to talk about is banks. And I know John and I talked about this. The banking industry in North America, I think, is more active. One, because they've invested probably a lot more into fossil-based organizations, and they've made quite a bit of money investing in these firms. And we want to reduce the fossils, but there will always be a need for some form of oil and gas and some feedstock. So you can't just cut it out immediately. It's just not practical. It's just not going to happen. We don't have the alternative. So the banks are behind, but now we're seeing the U.S. organizations, such as a couple of the large financial banks in the States, are now getting involved. And in our discussions with banks, they're doing work on their own. So what that means is they're investing in renewable energy for generating power for their branches, for their organizations. They're actually buying offsets for their locations. We're not finding many that are really pushing hard or encouraging customers to be active in that area. Now, there is one group that we're finding. So that we've spoke to 3 organizations in Canada. We spoke to RBC, TD, and BMO. And we're finding all 3 are active, but BMO is being more active in actually encouraging and engaging customers to take action. I'm not saying the other ones won't, but I think BMO, from what we see so far, has been much more active in that area, but it's an option. It's not a requirement that customers have to actually do this, but it's an attractive option. There could be some benefits of reducing their loan rate if they're successful in achieving those targets. That's a big change of mindset that goes on in banks, but also a big change that has to go on in an organization. But as I said to you earlier, I wish it was happening faster, but these are big organizations. So that's what we see happening on the hedge funds and also on the banks from my perspective. John, do you want to add?
Yeah, yeah. I was going to chime in there because I agree. I mean, here in UK and Europe, we do see quite a lot of NGOs pressuring banks about their fossil fuel investments. And, you're quite right. I mean, what these groups want is that they want the banks to immediately withdraw their investments or loans or whatever to fossil fuel companies. That's not realistic. But for those companies, for those banks to perhaps say it is our aim over 5, 10 years to disinvest, I think that would happen. I think at the moment banks are very much juggling what's going on with the people's perspective of them. So we're seeing increasingly statements being made by the global banks about what they're doing to combat the issue. How robust all those plans are is the same as anybody else. But I think where we can link back really to the last podcast when we were talking about risk. Now, if you're somebody that's going to invest money or lend money, you've got to look at the risk of doing that. So if we take into account some of the risks we were talking about in the last podcast, and we see somebody at a bank is then looking at somebody who's exposed to those risks, they're either not going to lend them, or they're going to put constraints on the loan, or they're going to charge them a higher interest rate because they think it's riskier. I mean, you see this simple model with credit cards. If you've got a good credit rating, you can get a credit card with a low interest rate. If you've got a poor credit rating, you have to pay a much, much higher rate. And that's the risk management taking place by the financial institution. And I think there is another dimension that we ought to touch on, and that is what I'm going to refer to as green investment. And this is where banks and governments as well are looking at the thing, rather than just questioning existing businesses. They're trying to identify opportunities where there are clear, nice green looking projects that money can be invested in. And here in the UK, the government's plan for green investment involves a number of strands, one of which is leveraging private finance, because government doesn't have a lot of it, and the other is they're thinking about a green bond that people could be investing, and then that money goes to sort of sustainability type projects and things like that. So without doubt, things have changed in that direction. I think we only have to go back to a linkage between Canada and the UK, which is Mark Carney, and how he has spoken out in the terms of what the banking bodies and financial bodies should be doing. We are going to get more questions asked. I think at the moment, I think Dave's right. I think it's not massively taken up. I think one of the reasons why here we have perhaps a little bit more legislation controlling some of these issues than some jurisdictions. So if you've got legislation in place, you don't really need to question the company quite in the same way. But again, as we're saying with all of these things, you've got to look forward to this. Money is going to get tougher to get if you are not taking due care of climate change and other environmental issues.
Very important. This will speed of change from hedge funds, the pension funds, to banking. Every year, it's going to speed up on requiring customers to make the appropriate change and to be able to demonstrate and verify that change. And so we have 2 customers right now that are undertaking that process. Now, I think they're leading edge, by the way, in what they're doing. Many customers aren't aware of that, but it's going to happen. I also think not only is there education required and knowledge based in the customer, but I actually even think the pension funds and the banks need to have the wherewithal and understanding or infrastructure to be able to put this in place as well. And John and I, we do this, we've done this for a long time, so we think it's pretty straightforward, but it's not. There's a lot that has to be learned, even within an organization, to actually put this into a customer's perspective. But it's going to happen quickly for sure, because it needs to.
Thank you for both of your responses. Now, Dave and John, you both touched on this already. Is an organization's climate change status impacting whether organizations can get loans? Is it impacting their credit integrity as well?
From our discussions with banks, it's not currently. It's not. They do have environmental questions that they ask. It's factored, but it doesn't really have a huge impact on them getting loans and actually the interest of the loan. It comes back to what John said earlier. It's what the loan impact is, their credit worthiness, what's their track record of making payments. And so, if you're just looking at the past, that's fine. But we've talked about how the climate's changing very quickly. That's not been factored in the past. So I currently think it's not as much of an issue as it will be going forward. John, what's your comments?
I see where you're coming from on that. What I would say is we do know that certain institutions are setting up specific funds for projects in, as I talked about, green finance and things like that. So there might be availability of money in a way that perhaps your organisation wouldn't have gone for it normally. Credit integrity, I think it will be bundled up with the whole ESG, the environment, social and governance issues that will impact on credit ratings. I think at the moment, credit ratings are far more instantaneous about somebody's ability to repay a loan or repay a debt or payment on time. I mean, if you check up any company now, one of the big parameters, in looking at it, is how good they are paying their bills.
Yes.
That still rates quite highly on there. And if you get a credit, Dun & Bradstreet or somebody like that, you get a credit rating on a company. Typically, they would say, "Oh, you should be safe for credit up to 10,000, 100,000, 2 million or whatever with this company." So I think it's still focused that way. But I think as they become more aware, I think we will find more hurdles perhaps, or more requirements, because it's quite interesting. What we hadn't mentioned here, and I'm going to throw it in, where we might see more pressure coming is through insurance companies. Because we go back to the risk thing again. And one of the things, what do you do to manage a risk? Sometimes you take out insurance. Now, if you drive a car, you legally have to have insurance, but you also have it, you go the extra bits, don't you, to get yourself a full repair or whatever. I'm fairly certain, I know from my days when I worked in retail, one of the things they were really interested in is how you'd protected your store against the possibility of fire. So if you put in sprinklers and fire protection, you could get a reduced premium. I think we will be seeing, and we probably are seeing, some similar things happening there in the environmental area.
I agree. In fact, so sometimes these expenses go into silos and it's not understood at a senior level. Those are questions we ask senior management on. What impact is your insurance? Are you seeing a change? Or what's the reason for that? And all you have to do is look at your home insurance here in Canada and how it's escalated so dramatically, and a lot of people are suggesting that's because of climate change. So
yeah, I think I was going to say I'm going to throw a trivial example in. A friend of mine, he bought a new car, a Range Rover it happens, and he got a quote for the insurance, and it was monstrous. And he said, "I don't get that." He said, "Because my wife's got a Range Rover and she's not paying as much." And it wasn't down to the fact that his wife is a different driver. It was down to the model of Range Rover that he got. And it was supposed to be a better target for car thieves. So therefore, they wanted to charge him a much higher rate. So that's how insurers work. And it's not going to take too many more natural disasters or problems affecting organisations where the insurers have to pay out before they go in. How do we protect ourselves? I know how we do. We either charge higher premiums or we have premiums and we have caveats that you have to carry out. We might well see insurance policies saying, have you carried out a climate change risk assessment? And if so, you need to share that with us. So they're completely aware of what the risks are that they're insuring.
In talking with some of the financial institutions, we know that they are looking at some issues. They're challenged to actually come up with a matrix that is actually the best when they're looking at climate change. So they are now referring to ESG as one of the indexes that they use to actually measure the customer's risk and associated with that. So ESG is now being used. Some people are questioning how effective that is as it relates to climate change, because it has so many other ingredients, governance and societal pieces besides environmental. That's being factored for sure, and that has an impact on possible interest in giving a loan and what the interest rates are.
It seems that getting loans is not a major issue now. However, are banks starting to care about how organizations get to net zero? What is their view on carbon offsets?
There are some banks that have interest in customers looking at this, but in our discussions with banks about this whole thing, they're more interested in what the banks are doing versus what customers are doing, because they don't have the infrastructure within their organization to request customers. In fact, in our discussions, they go, well, customers aren't even asking for this, so we're not even providing it, which seems kind of backwards to me, because you're the ones who actually are loaning them the money, so you should be figuring out their risk. So I didn't understand that commentary. But there are a few banks that are leading in this area, and they have green bonds, as John indicated, and there's organizations that have sustainability linked loans throughout North America. In our review in Canada, we think BMO seems to be more leading edge and further advanced in this setup. But I think other financial institutions are going to have to start looking at this.
Yeah, I think as well. I think I'm going to give a really unpleasant view, perhaps, and that is, I think at the moment banks really haven't got a clue how their customers are going to get to net zero, so therefore they're not interested at the moment. If your customer's not saying that bank's customer is not saying they're looking at net zero, you might be worried. It's going to take a few cycles of the process before that they get round to it. And as for the carbon offsets thing, I don't think that the banks have a real strong view on that, other than that they may be making investments into companies that are providing carbon offsets. And it could get rather interesting there if they start referring their customers to companies that they're investing in. I don't know if that would be a conflict of interest, but it's a potential growth area. So I think, this is a question where I don't like being that negative about it, but I don't think really the banks are yet concerned about whether you're buying offsets or not. I don't think is really an issue to them. Again, it comes down more to how you're behaving overall, and going back to Dave's ESG comment.
Myself and our listeners are big fans of real life scenarios. What examples are there of funds applying pressures on companies?
Well, we talked about this before. So Toyota, everyone knows the name. That's well recognized. My perception is a pretty darn good company. But last week there was an announcement where they were being encouraged by 4 specific funds that are invested in their business, and they're out of Europe. I would slaughter the name. I'll try. It's Adamaker Pension, Church of England Pension, Sweden AP7, and Norway Storebrand. They are 4 pension groups that are invested in Toyota that have conveyed to them that they need to change their behavior and thinking about climate and what are the steps they're going to take. And that was forced upon them. And I think you're going to hear, we've heard about Shell being required because courts in Holland. We also know that there's some activist investors that actually have got now some shareholders on Exxon involved. So there are activists and some forward-thinking pension funds that are actually now starting to drive this thought process. There's not a lot, but as we've indicated, I think as people get more educated and understand what needs to be done and why it needs to be done and how to do it, I think this will be only exponential going forward.
Yeah, I was going to mention that. I think the other thing to be aware of is the way that you have touched on this, but NGOs, for example, will acquire a small shareholding in a major company in order then that they can attend the AGM and that they can put things forward. And, they may initially be shouting into an empty space. But I think as time goes on, the more things like that happen, the more we are going to see. But I'm going to be playing the same old record. It all comes round to, in the end, it's the risk. Is the money I'm investing at risk? Can I get the person I'm investing that money with to behave better? If I can, that's great. If I can't, I might take my money elsewhere.
Yeah, and I want to add another piece because it's interesting. People are reviewing our LinkedIn post, and there are some people that believe that when some organizations are being really active at this climate thing, that they're scrupulous, they're not doing the right thing, when they don't understand business. I actually think what happens is, coming back, these pension funds are doing it because actually it makes good business. You got to do it because you don't have a business going forward unless, and I think that's misread by a lot of people. I think they think they're, tree huggers and they'd have no idea. I think these people are so forward thinking, they're going, if this company, if Toyota doesn't change as an investment that I have, I'm going to lose that investment that I have. It's a business driven reason why
Yes.
these people are being progressive. And I think that's misread by a lot of people out there.
Yeah. You go back to Interface Flooring and the whole story about them becoming, an environmentally friendly company. And that was a case of, questions from Wall Street about what were they doing about environmental issues, and the CEO thinking, I think I need to change the way this company operates. But it wasn't, it was driven, you're right. We've got to, hopefully, living in a market economy, we've got to hope that there are market solutions. But I'm just going to underpin that market solutions alone will not be enough to address this problem.
Agree.
Following up on those examples, now more on the organizational front. How do organizations prepare for the current and potential future impacts of climate change on revenues, expenditures, and cash flows?
Well,
Go ahead, John.
I was going to say, and it's an awful answer, in the same way they do for everything else, but they've got to have it on their agenda so that when they're doing their financial planning and everything else, they're going, oh yeah, what if? Somebody once said the whole purpose of a spreadsheet is to enable you to do what if calculations. You set up the spreadsheet and you go, oh, what are the variables? Oh, what if we put something in there? Back in the day, probably when Dave and I started in business, there weren't things called computers, and people wrote their accounts out in hard books, with pen and ink. And actually playing with the figures was something that became quite difficult and challenging to do. You can play with figures at the drop of a hat now, but you need to understand what those figures are, what they do. And I think one of the cases that I'm always keen on people looking at this is doing the range of options. What's the worst case, best case, average case? Because it doesn't take much longer to do that. And it's surprising sometimes when you do that kind of analysis what it tells you about your business.
I'll add, I think constant education and reading, understanding what's going on in the marketplace, how that could impact your business, starting at a senior level, whether it's a public corporation and you have a board, you got to be informed. And things are happening so fast, you can't not become informed and read and educate yourself continuously on this. That's a critical piece to this whole thing.
I think you both will like this next one then. So, how does an organization's board structure and the knowledge and skill sets of the board's members enable appropriate action on climate change issues?
So the board has to be knowledgeable about this. And I think we've indicated probably in nausea that we think most people aren't informed and educated about this. And it could be that they don't want to be informed, that they like it the way it's been. because everything's been really good to them. So I don't want to change what we're doing because I might lose my influence or my power. So that happens. But you need to engage the board in this process. And it's not one member, because it's got to be held, and this thought process has to be held throughout the whole board. So they need to become more informed. They probably need to get committees or outsource people to help them in developing that whole thought process. Then a plan has to be incorporated in their strategic direction as the organization. And as John said, and unfortunately, this whole climate thing is not a 3-year window. It's not a 5-year, it's much longer. But you got to look longer, and you have to have this thinking 10 years out. You got to make sure you can bridge this as board members change too. So I think it all starts with the board, then it moves to the executive. And then it has to become a part of the executives, part of their activity in their daily or even performance criteria, quite frankly. So it starts there, and then it gravitates throughout the whole organization. That's what I've seen. If that doesn't if it's not pushed at the executive or the board level, then my experience is not sustained.
Yeah, there are one or two examples. I think Procter and Gamble may be one where somebody at sort of C-suite level has taken an interest and said, we need to have somebody for sustainability or whatever, and start looking at changing products and all that. So I think that's one thing. I think what I worry about is, if you talk to us about energy management, and we will talk about the problem of having a lone energy manager. Well, I think we can have the same problem even in the C-suite, where we say, oh, we really ought to be doing something about these environmental issues. I know, we'll put somebody on the board responsible for environment. So what we do, we perhaps make that somebody who's, I don't know, oh, the HR director has got a bit of capacity. We'll make HR responsible for environment as well. Or we'll bring somebody else on, but guess what? We won't give them a department. We won't give them funding. We won't have real success until every member of the board is engaged with climate change, just the same way as they're engaged with the quality of the products they make, the marketing, and everything else. That said, we know we have a financial director, we have an operations director, so it does make sense to have a figurehead. But I think one of the things that boards need to be doing is doing a competence check on, do they have the competencies in place on the board to handle the broader range of sustainability, not just climate change. Do they have that in place? If not, what are they going to do about it? Are they going to educate existing board members, or are they going to bring somebody else on as a specialist?
Good news on this is, in speaking with some board members, they're saying it's like, if you would have spoken to them about this about 6 months, 8 months ago, not on the radar screen. Now it is raining and pouring on this, that they feel that they need to get a handle and do this. So I think the message is out. It's just, I hope that they take the appropriate action so it's sustained, that they don't think this is just a flavor, or that this is a long-term effect. So I think it's happening. Hopefully it's implemented and executed properly on an ongoing basis.
Yeah, to round it up, you will never get sustained, worthwhile change in an organization if the board isn't behind it.
Last question for today. How can the company's executive appraisal system support the integration of climate change issues into organizational decision-making and performance?
Well, my take is that in their performance criteria, there's a KPI that incorporates a piece of sustainability in their activities. And it's got to be something that's actually measurable, and that is reported on, and that they can demonstrate that they've taken action. It certainly helps that somehow their compensation is impacted by that performance criteria. And so if that can be done. That being said, I can say to you from our experience in working with teams, that money on the team side, anyhow, doesn't really drive the team to actually perform really well. There could be a disconnect between teams and the organization and executives. It might be driven differently. But certainly the teams, they have the passion to actually drive this thing and move it, because they know it's the right thing to do, and it brings benefits to them and to their peers. I think if we can create these KPIs for the executive, that are understood and that they report on. I think that would be the first.
I will add to that. In my past work, I did work with the Carbon Trust here in the UK. And I got, I'm going to be careful here. I'm not going to name the organisation concerned. But an organisation had had something like 20 surveys carried out by the Carbon Trust at different sites. It was a large company. And not much had happened. And the Carbon Trust wanted to find out why. And I got a nice piece of work, which was to go round, interview people at these 20 sites and try and find out why things hadn't happened. And I think it was best summed up, and I can't use the actual language that was used at the time, but it was best summed up by one manager where he said, well, it's quite simple. If it doesn't get more product out the door, and if I'm not interested in it, but if it's not about getting product out the door, if I'm not going to get a kick up the backside for not doing it, then I'm not going to do it either. And that was the problem, because they couldn't see how what was required would either, well, they wouldn't get, shall we say, punished in quotation marks for not doing it. So there's not an issue there. They probably wouldn't get praised for doing it, and they couldn't see how it would improve, turnover. I think as well, the other thing is we have to draw the big difference between business owners and people who work in a business. Because if you own the business, you're going to see the business opportunity there, and that's going to be fine. But if you're working in that business, you may be some way away from that money. And so the money, as Dave was saying with teams, the money isn't always the motivator. Often when people leave a company, they have an exit interview. Why are you leaving? Oh, I'm going to go and get more money elsewhere. That's not what drove them to get more money elsewhere. It was dissatisfaction with working with where they were. And then you think, well, if I'm going to move to another company, I might as well try and get more money. And then that gives you a nice excuse to say to your boss, without saying, I think you're a rubbish boss and a terrible organisation. You can say, I'm moving for more money.
Yeah, that's a really good point. And John, your observation, because we work with public and we work with private organizations, certainly that culture has a massive impact on their behavior. And so, when we work with these private owners that they own the business, and they have a longer term vision. And then the ones that are publicly, they can be shorter term thought process because they have to report quarterly results. So it's a whole different culture thing.
With the culture there, I always remember I used to do a lot of work for the government in the UK, and somebody said to me, one of the things you need to understand about somebody working for government is they never want to be responsible for a mistake. It doesn't matter if something doesn't happen. What does matter if something happens and it goes wrong. And I'm being very unkind to public sector employees with that by making that generalisation. But you have to think about the motivation, not just of the individual, but the motivational culture that the organisation produces. I mean, if we think, here we are sat on the internet, and you think about Google. Now, Google allow employees to go off and spend X% of their time doing whatever they like without having direction. So you've got that kind of organisation. Somebody wants to do things differently, they've got scope for it. On the other hand, if you've got something that says you've got 15 minutes on your timesheet that's not accounted for, does that encourage, experimentation? No, it doesn't.
On that passionate note, that's all for this week's episode. Thank you both for your time today, Dave and John. I look forward to talking to you again next week.
It's been a pleasure, as always.
Thanks.
Can't wait to see what we've got next week.
Yeah, I can't wait for these barn burning questions again.
Okay, talk soon.
That's all for today's episode of the 360 on Energy and Carbon podcast. Thanks for listening. Make sure to check us out on our website at 360energy.net and follow us on LinkedIn at 360 Energy Inc. Tune into our podcast on Apple Music and Spotify by searching the 360 on Energy and Carbon. You can watch the video recording and subscribe on YouTube at 360 Energy Inc. See you next week.